Hello, fellow traders. 'Tis I, the Rumpled One. Sunday, December the 3rd, the year 2017. The weekly gap and open. Let's get right to it and see what the market is showing us. Let's see, the market's, a minute or hour and 52 minutes old. And what do we have? We can see there's some huge gaps. Huge gaps here. Okay, let's see. We need to pick a different pair this weekend because I hate people think I cherry pick the pairs. Pick the euro, dollar. Let's take a look. You see it gap down. So, gap down 29. So we're looking to fade the gap back to this area right here. 118.90. So if you see a trade on that weekly gap, that would be it right there. And you can see here, looking at the daily chart, the euro is in the lower wick zone here, but you can see how big these wick zones are. So there's going to be a lot of time spent inside these zones, but I would venture that price is going to exit this zone, either to the top, to the bottom, or both. Right now it's only 4 pips above the open, which means we still have a possibility of a buy zone trade. It looks like there's been some action on the pound pairs. Look at the pound New Zealand. Holy cow, look at that. Closed the open 114. It just rocketed right off of the open. The pound CAD, same thing. Right off the open. And it went right through that lower wick zone. So fading the gap there would have been nice. Would have been a nice trade had you picked it up. But let's see, we're going to do the euro this week, I guess. And you can see here a buy zone. We had a couple of triggers. We had a high of 74. So there really wasn't much. 3, 4, 5 pips maybe, depending on where you triggered your long. And as you can see, the rat zones are overlapping. So there's no rat zone trade to be had at the time. And looking at the pivots, I haven't run the stats on the euro for the pivots, so I don't know about the missed pivots. I guess I'll have to put that up later this week. We can look at the missed pivots and see, but I do know that the dollar yen does not like to miss the pivot. So we've got the pivot way down here, pivot line. See, if we switch to the H4 chart, you can see the label comes out here. So this is kind of a runaway gap, though. I mean, if you look at it, was it 61 pips? That's a runaway. We'll just have to see what happens. This might be one of those pivots that doesn't get filled for a long time. And let's switch back over to the euro. As you can see, it's coming down to S1. Looks like it wants to come down here. You can see here to put in this low. So this looks like an area that we might see a reversal. Could play a rat zone trade off of that. And once again, you can see how big the wick zone is, the daily wick zones. Doesn't look like there's much there. And playing pure price action. Let's see, let's switch this back. Let's see what happened here. Okay, you can see that gap. You can see it went and then it came back down. Once again, looking here, possibly here, for price to go back up. If you drop down to M5, you can see the price action, red, green. We take the high break. It was good for a few pips. You can see here green, red. You take that break. You took some heat. And now you're in the money. Or maybe right here, you got the green, the red. Take that break right there. And you'd be up about 9 or 10 pips. Once again, no squigglies were harmed in the making of this video. Oh yeah, speaking of which, see, I think I already addressed it, but I think it bears repeating. So some guy made that comment about you have to know a lot about the market and blah, blah, blah. No, I say you don't. You know, Bruce Lee, you know, he fears the man that practices the one kick 10,000 times. So something as simple as this sweet spots gold indicator here, just to show you, the one that I modified, it puts the price boxes and gives you a few options. Really, this is pretty much all you need. It's just to trade the price action off of these horizontal lines. I mean, it doesn't matter. If you can look at the daily chart and you can see it's pretty much the same. Here you had a red followed by a green. You take the break of the high right there, and there was 300 pips to be had. I mean, maybe you came out here, you see the green followed by a red. You take the break here, that low, and there was just money to be made. You quite possibly you exited here. Maybe you even took the break here, or you waited. If you waited, you could see you got the green followed by a red. You maybe took the break out of that low. These are all daily trades, and you can just see how well, once again, red followed by green. Take the break of the high, which is a upper wick zone trade. Boom, to the north. Green followed by a red. You take that wick zone trade, which really wasn't much of a zone, but the point is you can see what happened next. So I contend you can use one method, and a method like this works every day. It doesn't matter. Market conditions are irrelevant. I mean, when people talk about that, I just think they don't know what they're talking about. A friend of mine, shout out to my buddy Ralph. Actually, Ralph was one of the guys, or probably the guy that got me into day trading way back in the early 2000s. He used to do some day trading, but he doesn't trade anymore. He does other things. But he also studied for law. And he said his professor told him, he goes, if you can't state your argument in one breath, basically one sentence, then you don't know what you're talking about. So, you know, learning that, thinking about that, it's just real simple. I can pretty much tell you, explain this in one breath. Green followed by red, right there. You take that trigger and you're short. I mean, what more is there? Really, what more is there? And he said that you need lots of methods. No, you really don't. I mean, we can come back here and we can look at the buy zone. This trade happens every day. I don't care about the market condition. There's only one condition where this trade doesn't work, and that's when the market is closed. But if the market is open for business and traders are trading, price is going to have to move away from the open price. It's that simple. You can't dispute it. So using this trade over and over again, that's all you need. You don't need more. Okay, somebody would counter, then why do I have these different methods? Well, I would say, well, you know, to answer your question, because if price isn't around the open, see here we have price around the open, this price we don't. But you can see here it's in the upper rat zone. So I have a chance to trade the rat zone trade here and here and here. All of these. That's red rat zone. These are all green rat zone trades. So I have that opportunity. So that's why I have more than one trade that I might make. So I've got the buy zone, I've got the rat zone trades, I've got the wick zones. But basically they're all horizontal line trades. You draw anywhere from 1 to 4 horizontal lines on your chart, and that's it. You're good to go. There's no more to it. Nothing more. No squigglies. You don't need them. And there was another thread where they were talking about indicators and why they don't work. Well, number one, indicators work. They do what they were designed to do. Now, you as a trader, you make interpretations and decisions based off what those indicators indicate. They're nothing more than a gauge. That's like saying a speedometer doesn't work. Well, or something like that. No, the speedometer shows you what the speed is. You know, how you react to what the speedometer says, or the temperature gauge, or the oil pressure gauge, you know, that's up to you. But the gauges are designed to do one thing, tell you what they're designed to tell you. Nothing more, nothing less. The problem is that people believe in voodoo and magic and crystal balls and all that other hokey stuff, as opposed to looking at what's real versus what's conceptual. And I've been over that before. You know, these lines, these daily opens, these, you know, previous days open, previous days highs, these lines are set in stone. I can change the time frame. These lines, the value of those lines do not change. It's just that simple. And so when price meets one of these lines and crosses it, if you take it in the direction of the cross, chances are you will have an opportunity to make money. I mean, case in point right here. When it crossed the open, you could be up 2 pips right now had you taken the trade at 181.61. Now it'd be up 1 pip. See, it's going to make a liar out of me here live. But the point is that, you know, these trades are solid. You know, those other ones, you change the time frame with a MA5 or EMA5 or RSI2, and then the indicator values change. Well, what good is it? I mean, really, what good is it? Because price is the same. I mean, the price is the same on all charts. It doesn't matter. All time frames. I can turn this into a weekly. What's the price? There it is. You know, price is moving around, but once again, it's, you know, 64. I put it on the hour chart. What's the price? Oh, it moved up to 65. Price is the same. You know, now look, you're up 4 pips. Now it's making me look smart. Yeah, but I just have to laugh at what these people try and preach out there. They try and get other people to believe. It's just ludicrous. But, you know, once again, simple horizontal line trade at the daily, weekly open. Right there. Boom. How hard is that? I mean, really, how hard is that? And I just don't understand why these people keep persisting in these myths. It's just beyond me. It really is. So, once again, these are statistically based trades. You can run the stats yourself. If you have some of my indicators, the frequency distributions, and you can run them to your heart's content and prove it to yourself. Or you can make your own indicator, or you can do it by hand. But the thing is, you can keep doing it and it's going to work every day. Because it's just that simple. So fellow traders, as always, it's not what you trade, it's how you trade it. This is TheRumpledOne signing off to start the week of bank draining. So let's go drain the banks.